Hi, I'm Kevin Castaneda, and this is Kev's Mindset, where we talk everything finance, investing, mindset, and productivity. And in this video, we're going to be talking a little bit about why the market is going down. So if you do enjoy this video, go ahead and smash the like button, and also go ahead and subscribe if you do want to watch more of my content in the future. Now let's head straight into the video. Okay, so today we saw quite a substantial sell-off in the market. Now, if you don't track the market a lot, a 1 to 2% drop in the S&P, NASDAQ, or Dow tends to be a big drop. You see stocks within these indices drop even more, like Nvidia down 3.5%, or something like Affirm down another 5%, or AT&T down 5%. These are pretty big moves for stocks in a single day. So we're looking at the whole market, and we're like, okay, the market's going down. Now, why is this going on? Well, the market's going down because Jerome Powell, he's the head of the Federal Reserve, is right now saying, hey, we think that inflation may not be transitory, or it may be more persistent than we previously believed it was going to be. Because if you haven't been following along to the Federal Reserve's narrative, they've been talking a lot about how they thought that inflation would be transitory, meaning that it would be here, yes, we would see large inflation, but that it would be a very short period of time. Now they're kind of reiterating the fact that they're worried about it and that they're not sure how long inflation is going to last. So with them not knowing how long inflation is going to last, they're looking at inflation and they're saying, okay, we think inflation is going to last a little longer. So what does that mean for us as the market? Well, that basically means that they need to raise interest rates. Now, that doesn't mean that they're going to do it right now. What they're first going to do is they're going to go ahead and taper. Right now, they're buying about $105 billion a month worth of bonds. And what this does is it kind of stimulates the bond market. It helps keep us afloat. It helps keep pushing some money into the economy and have things going on for the country. Now, when we get the Fed to start saying, hey, we want to taper, hey, we're a little worried about inflation, that means there's going to be less money coming in just from the Fed. On top of that, we're going to see interest rates raise. Usually you see kind of some sort of a correlation. Now, for every 1% interest rate that is increased, we usually see about a 10% fall in the housing market, and that's that's like the usual. It also makes money more expensive. It makes it more expensive for a business to borrow more money, to help fund their company. Now, why is this bad? Because companies like Apple, Amazon, Facebook, Twitter, a lot of these bigger companies, they borrow money and then they use that money to help fund and build their businesses even more than normal. So with interest rates going up, it makes it more expensive for a business to be able to take out debt. And with this, it creates kind of more of a risk in the stock market. It's like, okay, debt's more expensive, which means cash flow decreases, and inflation's still here. So that means things are still expensive. That means consumers are spending less. And we're looking at the market as a whole, and we're kind of saying, okay, there's a lot of turmoil going on. We have the new variant, which is coming out, and now the Moderna CEO is now saying that he thinks that it's going to be a lot worse than people expect, and that their vaccines that they have now are going to be less efficient against it and less effective. And even Merck is still kind of delaying the red pill, and we see all these things that have to do with the pandemic, and we're getting all these worries to start boiling up again, especially as we're heading into winter and people are starting to get worried about the fact of, okay, people get sick a lot easier because when it's cold, your immune system's weaker and you get sick a lot easier, which may mean that we get a spike in cases. Now, if this does happen, we will see a reduction in travel. We will see a reduction in spending, a reduction in going out. So we'll see recovery stocks like airlines, restaurants, and things like that be hurt from this, including retail as well. So from this, we're seeing the market kind of panic. Even software stocks are panicking because that's not as cheap. That's not going to be as cheap. And on top of that, inflation is going up, so things are getting more expensive. And all of these things are kind of compounding into one huge kind of market panic. So we did see somewhat of a sell-off the same way we did after Thanksgiving. The day after Thanksgiving, we saw about a 1.8% drop in the S&P. Today, we saw about a 1.6% drop in the S&P. So we're seeing some commotion go on in the market. We're seeing everyone panic and kind of get pretty frantic over what's going on. So with that, now that you know what's going on in the market, what am I doing right now just to kind of respond to it? Well, today I had about 80-ish% of cash 8% of my portfolio in cash at the time. And I deployed all of that today, actually. I bought a bunch of shares of AT&T as it's now gone down into the 22s, which means I'm getting over a 9% dividend yield for every single share that I buy at this price. The highest dividend yield I got from my last share was about 9.18%. I also bought some more Disney and I bought some more Meta or Facebook. And so I bought these three companies. Like, I'm continuing to average into all of them. And honestly, all that it takes is looking at the market, seeing the companies that you love. If they go down, then I'm happy to go ahead and buy some more shares. Let me know what you're doing in the market right now. There's a lot going on. There's kind of, whenever the market's unsure about its future, it tends to overreact and come down. And that's all I'm seeing right now. I don't see anything insane. I think that this is just kind of a natural progression that was going to happen anyway. It's just happening sooner than we expected. I think that cases will rise, but I don't know how fast and how sustainable they will last. I also think that our companies are really fast to innovate, so I think that a new vaccine for Omicron will come out very quickly. So that's what I'm seeing in the market right now. Let me know what you think in the comment section down below. Is there anything I missed? Are there any risks, other risks additional to these that you see in the market? What are you doing right now? I'd love to hear it. Thank you so much for watching this video. Go ahead and smash the like button if you did enjoy, and subscribe if you do want to watch more of my content in the future. See you in the next one. This was Kev's Mindset.